Hello, everyone. For the ones that are already live, I want to say that the webinar is going to start at 12, like planned. So we'll start to invite our speakers already on the scene. So we'll start to see them, and we'll start to invite all our attendees. So at 12 o'clock, we'll start the webinar with Matthew Ryan and the presentations. Hi, Matthew.
Hey, how are we doing?
We're fine, thank you. How are you?
Yeah, very good, thank you.
Okay, that's good. You find a good quiet room then.
Yeah, so all the meeting rooms, unfortunately, all booked up. It's very busy in London today because they've got all the country managers are here at the moment, and there's a
Oh
lot of
yeah,
other teams doing events and stuff. So I've had to go in one of these little booths, but yeah,
perfect.
it's all good.
No, we'll start on time at 12 o'clock. We're getting the invitees in the webinar now, so they're joining bit by bit, and then I'll kick off around 12 o'clock.
Super, sounds good.
Hello everyone, I'm Jonathan from Ebury. So we'll kick off this webinar about trading with South Africa. First of all, I want to thank all of you that are present in our webinar, but also the people that joined us here physically in Brussels in the offices of BC. Yeah, I want to thank our partners first because they enabled us to have this nice webinar. So I want to thank Claudine from the Belgian Chamber of Southern Africa, with whom we had the idea of creating this webinar. So if you have any inquiries about South Africa, I think she's the right party to address to. But also, I want to thank Jean-Marie and Jean-Philippe present here to help us on the technical part and allowing us to have this webinar physically in your offices and the business lunch afterwards. Also, if you have any inquiries as a Brussels company, you can address you can address to Jean-Marie or Jean-Philippe according for everything that's related to international activities. So the presentation will be in two parts. First, my colleague Matthew Ryan will start to give his presentation as the head of market strategy at Ebury. He will deep dive a bit in the macroeconomic part of trading with South Africa. And then I will have a more practical side of this presentation. So everything that's related to questions, I will ask you to, for the webinar side, to put those questions in the little tab down right on your screen. That's questions. You can write your questions there, and then we will handle them after the webinar. Also, for the people here, if you have any questions, just wait until the end of the presentation. I also have to mention that this presentation will be recorded. Don't worry, only my face will be recorded and the one of the speakers, but we'll share the recording afterwards. That way you can rewatch it or share it with your colleagues. So without further delay, I will give the word to my colleague Matthew Ryan that will take you into the macroeconomic part of trading with South Africa.
Excellent, thank you very much, and welcome everyone. Thank you all for joining our webinar today. I'm going to spend the next sort of 15 minutes or so just giving a sort of broad overview as to what we're seeing in the South African rand. First of all, as we'll talk about, the rand has been one of the worst performing currencies that we've seen and that we follow among the major and emerging market currencies in the past sort of year or so, and certainly year to date. So we'll talk about why that has been the case, what has driven the extent of this underperformance in the rand. I'll cover macroeconomics. We'll talk about the current situation in the South African economy, particularly the ongoing load shedding, power cuts, and what kind of impact that is having on the South African economy, notably the latest economic activity data. And then I'll give a sort of general view as to our thoughts on the rand. Is a recovery potentially on the way, or could we see a further sell-off in the currency? So I think if we're able to go to the first slide. I don't know if you guys are able to I can't quite see the screen. So if you're able to go to the first slide, maybe I can I'll get going, and then hopefully you guys can see it. But anyway, what have we seen in the rand? Well, the rand has shown a broad underperformance against, as I said, most major and emerging market currencies. Since the beginning of the year, the rand has sold off by around 8%. That's against the US dollar, and by approximately 13% against the dollar in the past year. There we go. We've got the slides up, brilliant. How does that compare to most other emerging market currencies? Well, only the Turkish lira and Russian ruble have performed worse during that time. Both currencies have been very much in the news. I'm sure many of you would have seen in the last a year or two. Obviously, Russia with the ongoing war in Ukraine and the various sanctions imposed on the Russian economy, which has had a significant impact on the ruble. And of course, in Turkey, the lira has been a clear exception among emerging market currencies, whereby we've seen a very sharp sell-off due to the unorthodox policy stance from Turkey's central bank. So aside from those two, the rand has been the worst performer. Why have we seen this sell-off in the rand? Well, first of all, we have seen broad strength in the US dollar for a starter against most other emerging market currencies. In the past sort of 6 to 12 months or so, the dollar has performed better than we had anticipated, and I think better than most of the market had anticipated, as the Federal Reserve has hiked its Fed's fund rate more aggressively than previously anticipated amid our ongoing the overshooting in US inflation. We've also seen heightened recession fears as inflation around the world breaks to fresh highs. Markets have been increasingly concerned about the possibility of recessions globally. What this has done is it's fueled safe haven flows into the likes of the dollar and led to a sell-off in some of the higher risk assets and some of the higher risk currencies, of which the South African rand is very much viewed as one of them. Indeed, of all the emerging market currencies that we cover, the rand is generally perceived as one, if not one of the most high risk among them. A number of reasons as to why that is the case. First of all, nominal interest rates in South Africa are very high. That tends to have two impacts really. During periods of optimism, during risk-on modes, whereby investors are confident in the state of the global economy, the rand is viewed as an attractive proposition to investors, given these high real rates and high nominal rates. But also during risk-off periods, where there are heightened concerns about the global economy, which is what we've seen in the last sort of 12 months or so, that acts against the rand, and the rand tends to underperform its peers during these risk-off periods. The current account deficit in South Africa is also very high. Again, tends to lead to larger swings in the currency during shifts in investors' risk sentiment, while the high political risk premium that we've seen and that has been attached to the rand for some time similarly amplifies these moves. So as I said, we've seen the rand largely underperform its emerging market peers as a result of the rand's high sensitivity to risk. If we go to the next slide, of course, there are more factors at play. I've talked about sort of the external factors, but clearly the domestic situation in South Africa has also had a significant impact on the extent of the sell-off that we've seen in the rand. Primarily concerns surrounding the ongoing power cuts, load shedding, which have really amplified in recent months and have stretched on to a very significant extent, longer than the market I think had expected, certainly longer than we had hoped. Many areas and cities are without power for more than 10 hours a day. with the state-owned energy company Exxon clearly unable to meet demand for energy. A number of reasons as to why that is the case. We've had a number of years whereby Exxon has not invested adequately in its infrastructure, in coal mining. South Africa is very much dependent, overly dependent on coal for energy, and that is clearly presenting a risk. We've seen recent worker strikes, a common theme, of course, not just in South Africa, but around the world at a time when inflation rates are rising very aggressively. And if wages are not necessarily able to keep up with that increase in prices, that has led to disruption among workforces. So these worker strikes have further amplified the mismatch between supply and demand. And we've seen similarly a number of years of corruption and sabotage within these energy production, which has further worsened the situation. What has that done? Well, I mean, clearly this has led to weaker economic activity in South Africa. I'm going to talk about that in a little bit of time and talk about the latest data that we're seeing. But at present, the outlook is not particularly encouraging. A recession so far has been avoided, but there is a possibility that we could get a technical recession at some point in the next few months, whereby we see 2 consecutive quarters of negative economic growth. We've also seen elevated inflation as a result of this inadequate energy supply. Inflation has started to moderate in South Africa, at least the headline measure of inflation, which includes energy prices, which is an encouraging sign. But again, as we'll talk about, core inflation in South Africa remains rather high, and that is presenting and will continue to present a downside risk to the outlook. The concern is that the worst may yet to become, may yet be on the way, I should say, as South Africa enters into its winter months. There is no let up in sight just yet. We're getting suggestions that the worst of this load shedding may be behind us towards the end of this year, maybe early next year, although that is highly uncertain. But that will certainly be something that investors keep very close eye on. And so long as we continue to see these prolonged and rather extreme periods of load shedding, investors could continue to take a bit of a dim view on the rand, at least in the sort of short to medium term. So how are these power cuts impacting economic data? Well, we've seen a general worsening in most indicators of economic activity in South Africa in the past few months or so. The main indicator of activity that we look at is the PMIs, the Purchasing Managers' Indexes. So for those of you that are not familiar with how these PMIs work, these are effectively surveys of business owners that are asked on a monthly basis whether they see higher business activity in the month ahead relative to the previous month or lower activity relative to the previous month. This is then composed and comprised into an index. Any number above the level of 50, that represents expansion in that sector, whereas a number below 50 suggests contraction. At the moment, what we're seeing is the composite PMI. So this is a weighted average of activity in both services and manufacturing. This has continued to print below the level of 50, i.e. in contractionary territory, in 4 of the past 5 months, including at the most latest reading in May, where it fell to 47.9. which, while not disastrous levels, is consistent with reasonable contraction in activity. Consumer spending is also deteriorated. The main measure we look at there is retail sales, which has held up okay under the circumstances, but we're still seeing contractions on a year-on-year basis, while unemployment remains sky high, one of the highest jobless rates globally. The main GDP data, again, as I said, it's held up reasonably well under the circumstances. There were some expectations that we could see a couple of periods of negative economic growth and maybe even a technical recession by now. Actually, we did see modest expansion, as you can see in the chart, only modest expansion in the first quarter of the year, which ensures that we're not likely to get a technical recession until perhaps the fourth quarter of this year. But having said that, the outlook is not particularly encouraging. As I said, the longer these power cuts drag on for, the more investors will be concerned that we could see potentially periods of contraction and maybe even, as I said, a technical recession before the end of the year. If we go to the next slide, thank you. One of the factors that has partly offset some of the downside that we're seeing in the rand in the past sort of 12 months or so has been the aggressive policy stance that we've seen from the South African Reserve Bank. The Central Bank of South Africa has raised interest rates at a pretty aggressive pace in the past year, around about, I think it's 400 basis points of hikes in the past 12 months, lifting the main base rate to 8.25%, which has been, by historical standards at least, a very aggressive pace of policy normalization. This, as I said, has partly offset some of the downside. It's provided some support for the rand and limited what would have been an even more significant depreciation in the currency. The task for the central bank has, however, become increasingly difficult in recent months. At the moment, and this is something that we're seeing not just in South Africa, but globally, we're in a period whereby inflation continues to run very hot, particularly the core rates of price growth, which strip out the volatile energy food components, but also economic activity is rather weak. A term that, at least among the major economies, we refer to as a stagflation, i.e. high inflation, very low economic activity. When both are sort of running in the same direction, it's quite an easy task for the central bank. When growth and inflation is high, the central bank can continue to raise interest rates. And when they're both low, the central bank can cut rates. But with both going in the opposite direction, there is a little bit of a trade-off. The central bank at the moment is prioritizing bringing down or attempting to bring down rates of inflation at the expense of growth. So this is something that we're seeing globally. As I said, most central bankers are prioritizing normalizing inflation rates in order to ensure a more healthy, longer-term growth outlook. But what that does do is that adds an extra downside risk to economies. As I said, inflation continues to run very hot in South Africa. The core inflation rate, which is the one that we're most interested in, given that it is the least volatile of the two measures, that has continued to print at above 6%, 6.2% in May, while inflation expectations, which are what investors or consumers, where they expect inflation to be in a number of years' time, that has continued to trend upwards. So that would suggest more interest rate hikes are likely to be needed. We did get another 50 basis point hike at the May meeting, but even that was greeted negatively by investors. The rand actually fell sharply following that announcement, as investors were hoping for a slightly larger move. So it has become very difficult for the central bank to not only balance the inflation and growth outlook, but also protect the rand, which has continued to sell off even following these aggressive rate hikes. If we go to the next slide, thank you. So what is our outlook for the rand? Well, where do we see the currency in the next sort of 6 to 12 months or so? Well, we are sort of in the process of revising our short-term forecasts for the rand lower, i.e. our forecast for the US dollar ZAR upwards. Why is that the case? Well, the power cuts, as I mentioned, have been longer and been more prolonged than we had anticipated. We think that there is now a greater risk of a downturn in the South African economy and potentially even a recession than we had anticipated 3 or 4 months ago when we last updated our forecasts. That said, while we do see the possibility of some near-term downside, we still continue to hold a relatively positive view on the rand, albeit not quite as optimistic as it once was. We think that once the power cuts become slightly less burdensome on the South African economy, as I mentioned earlier, potentially towards the end of this year or early 2024, then that should be a positive development for the rand. The issue, of course, being that it is quite a time-consuming endeavor to move away from this dependence on coal. I think that is going to be one of the key long-term challenges for the South African economy, is this move towards renewable energies, whether that be hydro or wind, solar energy, for instance. Hence why there is still some uncertainty and some potential downside in the near term. But if we look at the macroeconomic fundamentals in South Africa, actually they're still relatively strong, which is a source for encouragement. Real interest rates are very high in the current environment, around about 2.53%, which is around the highest level, as we can see in the chart, around the highest level that we've seen in a number of years. That should provide an attractive proposition for investors. Commodity prices remain elevated relative to previous years, a general positive supportive factor for emerging market currencies, particularly those currencies that are very commodity dependent, South Africa certainly being one of those. Foreign exchange reserves held at the central bank are also sufficient, around about 6 months worth of import cover, which is a reasonable amount when it comes to the central bank intervening in the market in order to protect the currency. And the sell-off that we have seen in the rand, as I said, the rand's been one of the worst performers in the last year. That has left it at very weak levels. When that is the case, we get to a stage whereby actually that currency that is sold off becomes a very attractive proposition for investors. It's very cheap. Investors will often reverse their bets on that currency, and that could lead to a bit of a snapback in the rand. I would lastly mention as well, I mean, the rand, as I said, very highly sentiment driven. It's very sensitive to shifts in risk appetite. And we hold a generally positive view on risk appetite and the global economy. So should we see the avoidance of recessions, not just in South Africa, but in the US, the Eurozone, around the world, then we think that should be good news for emerging market currencies in general, particularly the higher risk ones, which, as I mentioned, the South African rand is certainly one of those. But that's everything from me. So I'll hand back over to you guys to carry on the presentation.
Yes, thank you very much, Matthew. Thank you of ending on a happy note as well. So I will dig a little bit deeper on the more practical side of working with South Africa, so more on the transactions. Some of you already know us at Ebury. For other, we are just a new company. So I just wanted to briefly explain what we do and why we have this expertise to give you this presentation. So we are a financial service provider that enable our clients actually to work in 140 currencies worldwide. So we specify ourselves in cross-border payments, and also we provide services in cash management by opening accounts for our clients worldwide. But also, and more importantly, when we saw the presentation of Matthew, we try to also help our clients to protect themselves against volatility risks and foreign exchange risks that always there when we are working with another country. So just to give you a small snapshot of Ebury today, so we're active in 21 countries. We're quite successful right now with 240 currencies that we can provide. Our biggest majority shareholder is Banco Santander, so we're backed by a strong institutional player as well. But we still have the flexibility of being a scale up that can go on and tackle some issues more quickly than traditional players. So this gives you an idea of our presence. I like to say it, we are present in every time zone, and this gives us the best coverage, right? But so this was just a little bit about us, but it's not about us today. It's about the topic of cross-border payments, especially towards South Africa. So the idea is to look at when we start with cross-border payments, or when we're a Belgian company or South African company that want to work with one another, so Belgium with South Africa or South Africa with Belgium, what are the different things that we need to take into account if we look specifically and we zoom on those cross-border payments? So what are the challenges there? What are the costs that you have to take into account? Well, first of all, you have the conversion fee. I think that's the less transparent cost that you can have, but we say of the foreign exchange market, so the market where you can buy or sell different currencies, is an over-the-counter market. So it means like the difference with, for example, a stock, Amazon stock, we can all buy it on the New York Stock Exchange. We all pay the same price for it. It's listed on a centralized exchange. Well, for currencies, it's different. If we now ask all to our banks or our brokers which rates that we could have, or how many South African rand we will have for a euro, we will all have different rates because it depends on the conditions of the bank, it depends on relationship with the bank. But this makes it actually a cost that you don't see, but it's good to take it into account as well, because most of the time, I know we pay a lot of taxes in Belgium, but our banks are quite competitive on all those exchange rate. But it's not the same thing, for example, for more exotic countries like South Africa, or even other countries like, for example, China, where the banking system is a lot different. So this is also important to take this into account for your client, for your suppliers, for yourself. This is a cost that's present, of course. Besides that, there's a less transparent cost. I think you all aware, if you send payments somewhere in the world, that there are always transaction fees. That depends on your bank, the sending bank, but also the bank of the recipient, so the beneficiary bank, but also the intermediary banks, because as you know, when the payment is going around the globe, it's passing by different players that have actually all their small costs that is reflected in those transaction fees. So that's also something to take into account, because it's an additional cost. And then last but not least, as you saw in the presentation of Matthew, there's always an exchange risk. I mean, the exchange rate is, today's exchange rate is not the same as tomorrow and wasn't the same as yesterday. It moves based on supply and demand, based on all those metrics that are a little bit cold and harsh concerning the different economic metrics that you can have, and this is going to have an impact on the exchange rate, of course. So that's also something to take into account. The price of today is not going to be the price of tomorrow. So how can we optimize or take some control on those different costs? So first of all, I'm going to take the example of the importing side, so a Belgian company working with South Africa to import products there. Most of my clients at first start with, I like to pay in euros or in dollars to South Africa, because if I pay in euros, I don't have any exchange risk because it's laced with my supplier. Or the dollar is still the most used currency in cross-border payments. Last year, I think it was about 70% of all cross-border payments in the world. So even if the US is not implied, dollar is used quite often. Gives a false sense of security as well. as I'm gonna explain later. Because paying in euro sounds like the best idea because you're a Belgian company, you used to the currency, and then you think that you don't have exchange risk or you don't have that conversion cost that I talked about earlier, but that's not true because it lays with your supplier. And like most costs, the supplier is gonna reflect this to the consumer or to the buying side, which is you, which is normal. They're not gonna just take all the risk themselves. So this has the risk that, for example, a price that you have in euro, for example, with the South African company, that price can be adjusted if the movement is too big to carry on their for the supplier. So they're gonna adjust their prices based on the movements that you can have on this exchange rate. And like you've seen, it's quite volatile for the South African rand. So this will add price adjustments, not only based on commodities, on energy prices and whatever, but also on something as uncontrollable as the exchange rate. So the currency, the exchange rate, of course. So this is one side. This is why maybe it can be more interesting to work with South African rand instead of euro. But also the suppliers most often in those more exotic countries, if I can say it like that, don't have the same products or tools to protect themselves towards volatility. So this is what I'm referring with hedging. I'm gonna I'm gonna dig deeper into that later on, but it's a way to protect yourself against volatility by blocking exchange rate. But that's not always possible neither. And also, it just the fact, like I said, exchange rate depends from market to market, banks to banks, client to client. It can be more expensive for your supplier to exchange euros back to South African rand than it's for you to exchange euros to South African rand. And we've seen examples where it was up to 5% more expensive to convert it locally in South Africa than, for example, in Belgium. So this is something to take into account because I believe in a win-win situation in working with and considering local currencies when you work abroad. Why a win-win situation? I think for the supplier, of course, it's the ease of use. If you're based in South Africa, your costs, your overhead costs are in South African rand, your taxes are in South African rand. It's easier to just receive your own currency without having the hassle to convert it from euro or dollar. So just ease of use. I think we all like to pay in our own currency or receive payments in our own currency. It's just easier. Also, for the supplier, there's price stability. They can decide how many or how much South African rand they want to receive for a certain product that they sell, and they can just adapt it not anymore to the exchange rate. They don't have to look at that anymore. They just need to adapt it to commodity prices, inflation, and other things. But this is one thing that can lead more to price stability because exchange rates are quite volatile and they need to adjust it quite often there. There's also no need to work with buffers. Why I'm talking about buffer? Well, if they cannot hedge or work with fixed rates with their bank, probably they have to add a little buffer, a little percentage in their prices they put in euro or dollar just to cover themselves if the movement is of the exchange rate will happen in a month or in a week, because they're not going to adjust their prices every day at the exchange rate. So they need a small buffer that you, of course, will have to carry. Also, so for the importance of for in this instance for the Belgian company buying South Africa, why is it more interesting to work with the South African rand, or what would it be? Well, price stability as well. Like I said, the prices won't be adjusted to exchange rate. You can cover yourself probably through a hedging structure or whatever with your bank or with your specialized broker. And as well, the lower prices that you will have because this buffer that I'm talking about to take some of that movement on themselves will also be removed. So you will probably be able to buy at a lower price in South African rand. So I see this as a win-win situation, of course. But there's still a problem. You're gonna tell me it's like when you work with euros, for example, you don't have any issue of exchange and don't have to look at the exchange rate. It's also easier for you. But this is why you can. I have a small example to see what we can do about that. So let's say we have a small travel agency, a South trip. They want to organize a travel for 20 people to South Africa in March. They decide to do it in March 2023. The travel will happen a year later in 2024. They calculate that the cost will be budgeted at 2 million ZAR. At the moment that they make up that assumption, the exchange rate is euro ZAR around 20. So these 2 million ZAR translates in 100,000 euro as of cost for them. They want to have a profit margin of 50,000 euro. Yeah, that's fair for them, right? So they sell the travel at 7,500 euro per person for those 20 people, so at 150,000 euro. Of course, they use this budget at EUR 20 to calculate their costs, but the trip will only happen a year from now. So it's just a snapshot in time, the rate that they took. And what we see, this is not a movement we've seen really now, but just an example. If the ZAR reinforces themselves against the euro, we're 1 year later. They need to start paying their invoices. They need to pay for hotels, for the guides, for transportation, and whatever. And then the rate at that moment is at 16. So the cost that they budgeted at 20, euros are 20, are now much more. 2 million ZAR equals 125,000 euros of cost. So that profit margin that they calculated of 50,000 is now only worth 25,000. I mean, they could also adjust the prices towards the clients, but commercially that's much more difficult. So just the movement on the exchange rate, and I'm not taking anything into account neither, is going to impact their profit margin. So what can they do, or how can they mitigate that exchange risk? Yeah, that's the biggest risk that's related to this. First of all, like the first scenario is the scenario that they did. They buy all the ZAR at spot at that precise moment when they need to make the payment, so at the day rate. Yeah, then the exchange risk is 100% for them. It's a little bit you win some, you lose some mentality, but in this example, they lost quite a lot of money. So what can they do? Scenario 2 is they can say, okay, we need 2 million ZAR next year. We have made up our prices at this precise moment. We're gonna buy already those 2 million ZAR. We're gonna keep them into an account, and then when we have to start making payments, we just use those ZAR. So that way, the exchange rate risk actually is gone. It's reduced to zero. But yeah, as you know better than me, this is gonna create a big pressure on their liquidity because those 2 million ZAR are blocked in an account and they don't do anything with it. So the idea is for the one that already know the product and using it, they will know this. So the idea there is using a forward contract. This way you can fix the exchange rate for over a year, but without having any pressure on liquidity, because you will only need to convert euros to ZAR at the moment that you need to make some payment. So for the ones that don't know the product yet, what is a forward? What is hedging? It's actually just a tool that provides you a way of managing or mitigating that foreign exchange risk by actually having a predetermined exchange rate that you have with your bank or with a broker, regardless actually of where the current exchange rate is. So we don't look at where the rate is, we just fix the rate that we wanted. For example, for this travel agency, euros are at 20, for example. They know that in a year when they have to make payments, it's going to be at that precise exchange rate, and that way the budgeted profit margin of 50,000 euro will still hold on or make sense. Just I've added this slide because the people that maybe know forward contracts or hedging contracts will know the one from the banks that are sometimes less flexible, really a fixed contract, like we say. But you also have the possibility of working with window forwards that make you the ability to have a little bit more flexibility. For example, you can block a rate for a certain period without needing to know when exactly you need to make the payment. Here we have an example where there are different payments made in between the period that was covered at the predetermined exchange rate. So it makes it easy for you. You don't need to know exactly when, just the period when you need to make payments. So for this example of my travel agency, it would be, for example, April, May, and June. I don't know if they have to make payments for 3 months, and then they can just exchange at the time that they need to without having the risk of the exchange rate moving against them, but also without having to block any liquidity because they just exchange, for example, 400,000 euros at the moment that they need to. So this was the side of the importer. That's the most easy, more easy side for more easier side for South Africa. But because exporting companies or exporting towards South Africa is also possible working with the local currency. But as you may know, or not, that there are some currency controls. So this story, I'm just gonna take into account that you have the licenses, that you can work with South African rand and whatever for the exporting, so with the offshore South African rand. But also here, I see a lot of advantages of local currencies, of the use of South African rand, because for me, it's going to be maybe easier for you to sell your product as a Belgian company to South Africa if you made up your prices in South African rand, because every consumer or every client likes to pay in their own currency. So that makes it easier for them. It makes it easier for you based on what we've seen. You can leverage in negotiations as well. I don't know if you work with tenors or project based and that you fill in a tenor. Yeah, at moments, yeah, if you're the only one pricing them in South African rand, it's also easier for the South African company to work with you. And then I'm gonna use an example for that. It's most of the time also allow you to increase a little bit your margin because you are giving this ease of use of working in South African rand. So let's say we have a Flemish service provider that offers their services, their IT services directly to South Africa. They bill it in euro like they do it worldwide and like they used to do it in Belgium. The South African client needs to buy those euros, of course, so they have the conversion risk on them and the exchange risk on them, like I showed earlier. But after comparison, we've seen that the cost for the client, for the South African company, were at 4% with the conversion fee, with the transaction fees, and of course. So for the Flemish service provider, he starts invoicing in South African rand. He just increases a little bit his margin of 3% because now he takes the risk and the different costs that are related to this. But as you've seen, for the customer, it's nicer to pay in South African rand. It's at 1% less than what they used to pay in euro, and he can work in his own currency, so he is quite satisfied. The customer, the Flemish company, has only cost about around 1% for the exchange and for the transaction fee, so that way he has 2% extra margin for exactly the same product. So that's also very nice for him, and yes, he can expand his client base quite easily that way. Yeah, so again, if you have the disadvantage of having the exchange risk on yourself, but this can be a solution for forward contracts. So I'm anticipating already maybe on a question on this side of the business. Of course, like I said, South Africa is a bit difficult sometimes to get South African rand out of the country, but now I'm just taking into account that this license is already applying in this context. So I think actually we're quite in time, like a clock. So I have some time now for questions. I don't know if in the webinar there are questions yet. So, but if you have one, you can add them to the tab below at the right bottom, questions, or if some people here have any questions, I'm happy to answer them. Yes. Mm-hmm. Yeah. Yeah. Of course. Yeah. Okay. No, it's a good comment actually. I'm just gonna repeat it for the webinar because I'm not sure they heard it. So we have someone here present that's actually importing from South Africa, but his suppliers are not willing to to invoice in South African rand. They want to keep paying in euro and dollar because, of course, it's a more attractive currency because it's a hard currency. And this is the issue we've seen quite a lot. Actually, to be honest with you, the ambition of Ibri is also to open offices locally because that way we can have actually the relation with the supplier and try to show them the advantages as well and offer that service from their side. It's something we did quite successfully with China, for example, where it's the same thing, right? Most of the people buy in euro and in dollar, even if now China is that they want to internationalize their currency, so it's a bit easier. But having local people help us to get into contact with them because most of the time we're not. I mean, it's also because your supplier, he knows that he has some extra margin, of course, the fact that you pay in euro and dollars, and then he can manage himself this exchange, of course. And like you said, his cost in rent will be probably covered by the sale of goods in the country themselves. But eventually, at one time, I guess if he has no cost in euro or in dollar, he will convert them back to South African rand. So he's just trying to get him there with communication, with transparency, and showing them why it's also in their advantage. And I understand it's difficult from here and there. So this is why, from our side, we try to have local people, that understand the system and the banking system there as well. And I think this is in the, I mean, yeah, I have I have both. I have both. I have clients that we managed to convince them to pay the South African rent. Some of the suppliers just didn't know it was possible, or that it was too difficult, that were afraid of doing it, because it was export, import, and whatever. But eventually we managed to do it. So yeah, I'm not saying it's a general rule, but you see the advantage of doing it. So yeah, eventually maybe you will convince them to do it. Uh, no, it's Claudine. Yeah, that's actually quite interesting. Like you said, maybe yeah, that they need to build up those reserves because yeah, we've seen South African rand being really volatile and performing really badly also the last year. But I think it's also this, in that way, for the supplier, a way of receiving euros, and that way receiving more South African rand for the same product as the movement goes along like this. Because if the movement goes in the other way around, and then they will need to adjust the payments, then the conversation is also a little bit different at that precise moment. So yeah. Yes. Yeah. 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 No. No, you're right, and this is a topic we've seen a lot. The difference between parallel rates and official rates, especially in Africa, and this makes the whole topic that I said, the conversion fee and the conversion cost in the relationship, even more difficult because it's even less transparent. So yeah, indeed, that's also something to take into account as well. But yeah, we try to, like, I think Oliver is the good example with you. We try to get this conversation and try to manage it that way. I've been successful with some, not with all of them, but yeah, this is all about having this communication and also being aware of it. This is what you already aware of it. If it doesn't change, okay, so be it. But being aware and having this communication and this conversation is already, exactly, it's already. Mhm. Okay, so I don't think there are any questions from the webinar sites. I would like to finish off by once again saying big thank you to Claudine and to so the BCSA and Bessie of organizing this together with us. Also, Matthew, thank you for your time for this presentation, and then also thank you, Amanda, who's part of our marketing team that helps me and supported me because I wouldn't be able to do this alone. So. I don't know if you want to add something, Claudine, to finish off.
No, no, thank you for very interesting topic. And funny enough, no load shedding today. Or I mean, it's been a bit better the last few days, but I think everybody's scared when that happens because then they think it's gonna hit us hard in a few days time. So but yes, thank you for that. And I believe Iberi, you need to come over here in South Africa to indeed explain and push that I mean the service that you offer, and in which indeed makes a lot of sense when you explain it, and probably not everybody realizes that it's the best way to trade in your local currency. So thank you for a very clear explanation.
Thank you, Claudine. I will keep this recording and push
Yes.
with your comments much more inside of Iberia. Hopefully, I can join you in South Africa soon. Then.
Okay. Always.
Okay,
Cool.
and also for the young people, this is recorded. I will share everything by mail, also with the contact details of Bessie and the Belgian Chamber of Southern Africa, and that way you can also have their contact details. So thank you very much, and I wish you a happy day and end of the week.
Thank you, everyone.